Hello everybody, welcome to another CISI session for the Level 2 Fundamentals of Financial Services qualification. This is session number 17, continuing from the derivatives session that we started in session 16. So this time we're going to be looking at futures and options. So this is all part of chapter 6, derivatives. So as always, I'm joined by two professionals working in the industry. So we have Elliott Colemen with us, who's a consultant relations at AQR Capital Management, and Elliott joined us for the previous session video. So Elliott in that session spoke a bit about what he does, what AQR Capital all about. So thanks very much for being with us again, Elliott. It's nice to see you.
It's a pleasure. Thanks for having me again.
Excellent. And I've also got a new face. We've got Roch here, who's a fund analyst at Invesco. So we're just going to ask Hugh to tell us a bit about Invesco, what they do as a firm, what Hugh does in his role, and how he got there. So Hugh, welcome. Over to you to tell us a bit about yourself.
Hi guys, thank you for having me. So yeah, as said, my name's Hugh. I work as an analyst at Invesco. So Invesco are a asset management company. So what Invesco do on the whole is they have a selection of funds which people could have their money in. It might be the case that a company's pensions are invested in our funds. It might be someone's savings, a whole broad range of different things. I work on a team that we run multi-asset funds. So what that means is we run funds that can invest in a broad range of asset classes, and we can invest sort of in the best way we see fit to meet our particular objectives for the fund. I guess where we differ from a lot of funds is where we can use derivatives and all kinds of different asset classes as opposed to just being bonds or maybe equity. In terms of my personal background, I did an engineering degree at Loughborough University. And then from that, I eventually joined Invesco on a grad role, which was in one of the technology teams. I learned a lot about how the world worked, of asset management and how all the systems worked. And now I work as an analyst in one of the investment teams. But the portion of the team I work in is largely about what instruments are we using, monitoring them, checking we're doing it right, and sort of running the portfolios from a technical point of view. So yeah, that's me.
Thanks very much, Hugh. Thanks for the introduction to yourself. Did you say you got onto the grad program at Invesco?
Yes. So it was the particular thing I personally did is a scheme that was one of the initial things a few years ago, which they don't do anymore. But there are now a lot of opportunities at Invesco through the Investment 2020 scheme. So that's the main grad thing these days at Invesco. That wasn't when I joined. But yes, through a graduate program essentially.
Graduate scheme. It's interesting you mentioned Investment 2020. We the CISI partner with them, Investment 2020 on an alternative program that we offer. So a great way to get into investment management for sure. Really good pathways there from a school leaver and a graduate perspective.
Definitely.
Amongst all the big investment management firms. So yeah, that's great. Thanks very much, Hugh. That's really good to know. And just out of interest, why? So you did the engineering background. What made you go into financial services instead of staying down that route?
I mean, to be honest, it wasn't really that much of a thought out plan that I planned to go work in financial services. It was more that I knew of Invesco as an employer. I'd known other people who probably were more naturally inclined to finance, who had worked there and said they're a great employer. They were relatively local to where I lived, and there was an opportunity which, from the technical point of view, was quite close to my skill set. There's a lot of data analysis, a lot of problem solving in engineering, and that fitted the role that was there. And having known they were a good employer, and then when I got into that, I would then realise that actually I am really interested in more of the finance stuff that I had been less exposed to initially.
Interesting, you should say about the transferable skills that there are between the two disciplines, if you like, which people might initially think are chalk and cheese, very, very different to each other, but actually a lot that you can take from engineering is very applicable to working in financial services. Absolutely, and that's really interesting. Really interesting. One of the things we do say to students is, don't think that you have to go down the route of having an economics degree or a maths degree, something in maths, or you can do something else. Obviously, engineering is you have to be very numerate, but
yes,
you don't have.
It's not pure maths. Yeah.
Sure, exactly. So that's really, really useful to hear. So thanks for that, Hugh. And actually, Elliott, I was going to bring you in on this because when we spoke in the previous session about what you do, did you go down the graduate entry route, or?
Yes, I did. I started on the grad scheme at Morgan Stanley. So what I did was, as part of my university degree, it was called a 4-year thick sandwich course. So I took a year out, like I had a year internship, which I did at Morgan Stanley. So obviously got to know the people, the team, the company, etc. Luckily made a good impression that they gave me an offer once I graduated. So yeah, that's how I got my foot in the door into finance.
Interesting, excellent. And Hugh, how long have you been working at Invesco now?
That is a good question. I think 6 or 7 years. So I did like 3 years in sort of the technical team, starting off in the grad thing and then sort of getting a like permanent contract, as it were. So the grad things, I don't know if it was the same for you, Elliott, but they're sort of fixed term contracts. And then from that team, moved on to the team I'm in now, I guess about 3-ish years ago too. So.
Right, excellent. Elliott, how long have you been at AQR?
So I've been at AQR for about 4 years now. But as I said, I didn't start at AQR. I've done, as I mentioned in the previous talk, a few different roles. So started off on what we call the sell side, so investment banking with Morgan Stanley, and then eventually making my way over to the buy side, which we call asset management at AQR.
Okay, great, brilliant, thank you. Well, thank you both very much. Thanks, Elliott, for the recap, and thanks you for giving us an insight into your role and what Invesco do as well. So thanks, guys. So focusing on the session now in terms of what we're going to cover off. So in the previous session, we spoke about what derivatives are, what their uses are in terms of hedging and speculating, and then we mentioned forwards, which we'll recap on in a moment. This session is very much about futures and options, two alternative types of derivative contracts which work. Futures in a similar way to forwards, and options are something very different from those two types of derivative. So we're going to look at what they are and basically how they work. Okay, so in terms of a recap from the previous sessions, as I said, we looked at derivatives, their uses, and we also focused on what a forward contract is. And if you recall and cast your mind back to that previous session, we spoke about how this forward contract is when an asset is traded. So a derivative is a contract where the value is derived or comes from an underlying asset. So we use the example of a farmer and a merchant trading something like wheat, and how a price and the quality, quantity, date for delivery, where the asset will be delivered to, all of that stuff is negotiated directly between the farmer and the merchant, or the two counterparties in that contract. So everything is determined between those two individuals, and all the terms are set by those. And if you remember, we called that an over-the-counter traded derivative, or OTC, and that's where all of those terms are discussed and agreed between those two parties. So that type of derivative where the asset is delivered and the money exchanged at a future date, but all of the terms are negotiated and agreed up front by the two parties, that is a forward contract in terms of a derivative. And these are some of the original derivatives that kind of came out of trading between two parties maybe a few hundred years ago. Okay, so what we're going to look at are futures and options now. So I'm going to just go to one of our professionals here. So I'm going to ask Hugh, can you tell us a little bit about what futures are for me, please?
Yeah, of course. So a future is very, very similar to the forwards that you discussed previously, and you just did the quick recap on. Essentially, you're agreeing to buy something in the future. But the thing that's different about futures is they are very much a standardized instrument. So lots of people trading forwards. As per the slide there, Chicago Board of Trade started introducing this idea of futures contracts, where it would be, instead of just iPhone Elliott and say, I want to do a forward agreement with you to buy your wheat in 3 months' time, I can instead go to an exchange and I'll see what the standard listing is, and it'll be like, okay, you can have, I don't know, 1,000 bits of wheat, and in 3 months' time, and the quality of the wheat, which is one of the really specific things that's quite hard to, well, not hard, but one of the interesting things to think about is you want to ensure that the wheat you're getting in 3 months' time is of a desirable quality. So they've written that down and it's standardized. So I know that the wheat I get in 3 months' time is going to be conforming with whatever the rule is. So these are the standardized elements of it. And then the price is what the price is. And the price is then impacted by all the things that normally impact price in terms of demand. If lots of people want it, it's going to be more expensive. If no one wants it, it's going to be cheaper. One of the things that this probably impacts forwards as well. So you might have mentioned this already. There's this idea of, are there any benefits to actually holding the wheat yourself? Or is it easier for someone else to hold the wheat? So maybe I don't have a warehouse for the wheat. So I want to agree to buy wheat in 3 months' time. And Elliott's like, well, fine, but I'm paying rent on my warehouse here so that I can keep this wheat because you won't buy it today. And the cost of that gets factored into the price. So these are all things that, and that does happen in forwards to an extent too. But again, it's, I guess it's quite transparent in the price of a future because there's not a lot else moving. So because everything is standardized, that benefit or cost of carry is how it's referred to, is quite transparent. They're traded on an exchange, so you can just look at the exchange, look at what the price is. That makes them pretty liquid. I'm not trying to find someone to do my trade with. There's loads of people who want to do this trade. That makes things liquid. That removes a lot of the risk because you can get rid of it quite easy if you wanted to. Again, because there's lots of people trading it. And yeah, they're probably the main differences between futures and forwards. The other one, which is a specific risk of the forward, is I'm very exposed to, in my wheat example, I'm very exposed to Elliott actually delivering the wheat at the end. He's supposed to because he's got a contract. But if he doesn't, then I'm very exposed to one counterparty going bust. Maybe his business goes bust. Who knows? Whereas when it's exchange traded, there's a lot more inbuilt protection to avoid that risk. That's not so much there with the forwards. Yeah.
Thanks, you. I've just put the slide up here about how they work because in what you've spoken about there, you kind of mentioned some of the elements there about how they work and talking about the standardized terms. So as you said, they're very, very similar to a forward. It's just that this is traded on an exchange. And as you said, all of the terms pretty much are standardized, set by the exchange. The only one they really have that opportunity for the two parties to kind of negotiate is that price, right? Is that correct?
Yeah, completely. No choice on anything else. So you get what you get, and it costs what you decide it costs.
Yeah, sure, absolutely. So the quality, the quantity, the date for exchange of the asset and the money, all of this stuff is determined already by the exchange, as Hugh spoke about. So, we've got this example up here of a future for, say, jet fuel, and you've got Shell, who are the seller of the asset, and British Airways that are the buyer. So British Airways are buying the jet fuel. So they go onto an exchange, and there are these contracts, as Hugh said, sitting there that they can just go, right, there we go, we're going to buy that, or we're going to enter into that futures contract. So the key thing here is, as Hugh has also said, is about this legal. You kind of got this ability to try and put things right if something goes wrong. Is that right, Hugh?
Yeah. So there's this idea of essentially the futures are marked to market and the value is held by the exchange or by a third party, so that there's no more risk than sort of the in between of the last time that happened, as opposed to if the value of the future has changed dramatically over the 3-month period, then particularly let's say the value's gone up and you've bought it, if it wasn't going to be delivered or there was going to be a problem, you're going to lose loads of money if it's over a 3-month period. So that there's this idea that it's there's sort of insurance in place which takes place every sort of day or whatever it might be, so that you're only exposed to a day's worth of risk, as it were, in terms of someone disappearing.
Yeah, of course.
I guess
Absolutely.
the simple way to explain it.
No, it makes absolute sense. Yeah, you're absolutely right. So yeah, it mitigates some of that. Like you say, it doesn't lengthen or increase the level of risk. It minimises it to a certain period of time. So yeah, it makes absolute sense. So so the big differences then between the futures and forwards, as kind of Hugh has spoken about and highlighted here, is that obviously with the forward contract, it's directly between the individuals and they get to negotiate all of those terms. And as Hugh said, there is an increased possibility that one of the parties might default on their obligations, if you like, or not deliver what they said they were going to deliver, which increases that level of risk. But as Hugh, sorry, I've been doing a few of these recordings today. As Hugh spoke about with the futures contracts, because you've got that exchange in there, you've got these standardized terms. So it's kind of an off-the-shelf contract that you are buying into, where you're buying or selling the asset. So yeah, they're very, as you said, Hugh, quite a lot of similarities there between futures and forwards. It's just this idea that the future is legally binding on an exchange rather than over the counter, and most of the terms, except for the price, are set by that exchange. So it gives you less variables to negotiate and play around with. Is there anything, Hugh, that you wanted to add on, anything there that we haven't spoken about that you feel people might want to know about?
I guess the only thing to add is sort of maybe in a large portion of sort of the real world market for futures is, as per the examples given, yes, aviation firms and oil companies do a huge amount of trading in oil futures to sort of make sure they're hedged their risk, because if the oil price drops, that's great for the aviation, it's not so great for the oil company, and vice versa. So there is a lot of that in terms of sort of commodity futures. But from like our point of view, when we're running funds and things, it's not impossible that we would do that kind of stuff, but it's much more likely we'd be looking at futures on exchanges. So like the FTSE 100 you can buy a future contract on. Now, when you get to the end of the contract, they're not going to drive a van to the house with some kind of physical representation of an index. But what happens is you end up with a cash settlement. So you sort of you end up rolling the future, which is essentially selling your holding, and you make or lose the difference between the price you bought it at and the price you sold it at. But during that period, when we're holding it, we're effectively exposed to the value of that index going up. The other interesting thing you can do is you can go the opposite way. You can sell the futures so that we can be exposed to let's say we thought the value was going to go down, then we can go short the futures contract and then buy them back at the end. So it allows us to trade both ways. It's quite difficult to do that with real things, in terms of there's a lot of complications with shorting real stuff. But when it comes to futures, it makes a very easy method of transfer for that.
So it's something that we spoke about in the previous session when we looked at derivatives, and we spoke about how you would get contracts on for commodities, but also you will have financial instruments that are traded via these derivatives. So that's what you're referring to there, Hugh, isn't it? About using
yes, exactly.
Absolutely. So that's a really good example there, Hugh. Thanks for that. It gives a bit more context around how they might work, and the use of those rather than as opposed to using it to trade things like oil and commodities like that. So thanks very much. It's really useful. So that's futures, how they compare with forwards, and a bit about how they work. So thanks very much, Hugh, for that. It was really useful. So we've covered forwards in a previous session. We've now looked at futures. The other type of derivative that you need to know about for this qualification are options, which are quite different from forwards and futures. So I'm going to hand over to our other professional in the room, Elliott, Elliott, if you can just tell us a bit about options and the way they work, that would be really great.
Sure, glad to. So I'm going to try and make this as simple as possible. But an option is basically a contract that gives the holder, who we would call an owner, the right, but not the obligation, to transact in a specified asset at a specified price with the seller, who we also call the writer of the option. So the time frame in which you can use this option, or otherwise known as exercise the option, can vary depending on the type of options traded. Some will only allow you to exercise the option on a specific day, and some may allow you to exercise the option within a window of time. It just depends on the type of option traded. But nevertheless, the last date that you can use the option is known as the expiry, the option expiry date. And Hugh just briefly touched on futures and expiry as well, where he mentioned that at the end of the period of the contract, which is known as the expiry, there is an option to roll the position, which just means to enter into another contract to keep the exposure on. Okay, so whilst the holder of the option is not obliged to transact, they have the option, hence the name, the writer of the option is obliged if the holder chooses to. So you may ask yourself at this point, what motivates someone to sell an option if they are obliged to do something, but the holder or the buyer of the option just has the option and they're not obliged necessarily? Well, the writer of the option, they receive a fee for this, which is known as the option premium. So that is one of the motivations as to why someone may want to be the seller of an option.
So ultimately, Elliott, what we're saying there is kind of the way they differ from a future is that with a future, they're obliged to, unless they rolled that contract on, they're obliged to either deliver the asset or part with their cash at the end of that, when it gets to that expiry date. Whereas with this, the buyer has a choice. The buyer of the option has a choice about what they do at that expiry date. So they're not obliged to do anything. They can either do one thing or let it lapse, and so they can choose to do one thing, or they can let it lapse and it expires and it just disappears. But they get charged an upfront cost for that, which is known as the premium, which they pay to the seller of the contract or the writer of the option. Is that right?
Exactly, that's correct. And we're using some of these terms. Hopefully it will sort of become a bit more tangible to you. So the term premium, you may have seen that before with your maybe mobile phone insurance. You pay a premium, which is a nominal amount to the insurance company, who are then obliged to restore your phone if in the future something were to happen to it. And it's a kind of similar concept when we're thinking about financial options as well. You can also think of the seller almost as an underwriter, almost like an insurance premium that they're receiving, because they will be obliged to do something should the holder or the buyer of the option want to in the future. And I guess just putting it in financial terms, if we think about this in terms of an option on a stock, or on a security. So let's just say it's Vodafone. Hopefully everybody knows Vodafone. If you were a buyer of what we call call option, which gives you the right to buy, you would exercise that option in the future if the price that you you had the right to buy at was less than the current market price, because that means that you could buy Vodafone for cheaper than it's currently trading at. And likewise, there's another option called a put option, which gives you the right to sell. So if you were holding Vodafone and you were worried about the price potentially dropping in the future, but you wasn't too sure about it, you could buy a put option, which would give you the right to sell your Vodafone shares at a particular price. And again, you would only exercise that if the price in the option was higher than the current market price. So for instance, if your option gave you a right to sell at £10, but the current market price for Vodafone was £5, then you'd obviously want to sell and make £10 as opposed to sell and make £5 in the market. And I guess yeah.
Sorry, Elliott, go on. Sorry.
No, I was going to say, so you can see that the risk of that transaction, the writer of the option does have a risk, and hence they demand an upfront premium to take on this risk.
Yeah, it's a bit like you were saying about premiums in like a phone insurance contract. The premium, it's a bit like a deposit, isn't it? A non-refundable deposit that you put down, that the seller walks away with something if you don't exercise the option when it expires. So there's some, they get money in their pocket for that. As you say, it's kind of like it's a deposit, but the kind of fee for doing what they've done. It's this it's just so they've got something there to walk away with. But I mean, the example you used there, Elliott, as well. I mean, we've got something up on the slides there, which is a kind of basic, as you said, a call option, which we'll look at the difference between that and a put option in a moment, in a little bit more depth with an example. But in this case, just to kind of give you how option works, and Elliott was given a good example there, and here's a slightly different one. If you had a bank that had written a call option to sell some shares to somebody that buys that option contract. So if the bank had written an option that said that the buyer of the option could buy 1,000 shares in a particular company for say £5 a share, and the expiry date is in 3 months' time, the individual or the party that buys that options contract, so say it's an investor, so they pay the upfront premium to the writer of the contract, which is the bank, also known as the seller. They pay that premium, and then the buyer of the option has that choice at that 3-month expiry date to either buy the shares, the 1,000 shares at £5 a share, or they can choose to let the option lapse and just disappear. And so they would have paid the premium, but then they're not obliged to pay anything else because they haven't exercised the option and it's disappeared, it's lapsed, it's gone. So as Elliott was saying in his example there, it's the same here. Depending on the market price of those shares when it gets to that expiry date, that will determine whether the buyer of that call option decides to exercise that option and take up the purchase of those 1,000 shares at that price. So if the share price in this example at the 3-month expiry date dips below the £5 per share mark, it's highly unlikely that that person buying the option would exercise it and take it up and actually go through with buying those 1,000 shares for £5 a share. If the price of the shares go up above the £5 per share, they might want to then factor in the premium they paid for the contract, but then it's more likely that they might exercise that option and buy those shares at that price. So it depends on the value of the asset at the expiry date as to whether or not the buyer of that contract, in this case the call option, decides to exercise and take up the option of buying those 1,000 shares at £5 a share. So that's as Elliott was giving the example there, very similar to this up on the screen here, but it all depends on the value of that asset at the expiry date as to whether or not, in this option example, the buyer of the option will actually go through with it and buy those shares. If not, the premium's been paid, the seller walks away with the premium, and the buyer isn't committed to buying those shares. They've walked away from the contract. So very different from a future in that there's this obligation for it to go ahead and that trade to happen, whereas in this case there is that choice, isn't there, of yes or no, I will or I won't. So there's no obligation. You have the right, as Elliott said, to either exercise it and go through with it or not, as the case may be. And thanks, Elliott, for bringing up that kind of difference between the two option types. So the fact that you've got a call option and a put option. So there's two different types of options that you need to be aware of. And this is probably one of the more, I think, for students, one of the more complicated things to get their heads around is this difference between the call and the put option. I think this and bond pricing is probably the two things that students struggle with more. So in terms of the different options, Elliott mentioned about call and put options, and we've got on the right hand side here the difference. And Elliott mentioned that a call option is kind of your straight up what you would kind of expect, where the buyer of the contract commits to buying the, or should I say, has the right to buy the asset at the price that's been agreed. The seller of the contract is obliged to deliver the asset if the buyer exercises it and takes up that option. Okay, so actually exercises the option at the expiry date. And with the put option, you reverse that round. So the buyer of the option doesn't have the right to buy the asset, but have the right to sell the asset. And the seller is obliged to take delivery if the buyer decides they want to exercise that option at the expiry date and sell that asset to the seller of the contract. So it's quite, so kind of the difference here, and correct me if I'm wrong, guys, with futures, when we're talking about buyers and sellers, we're talking about the buyer and seller of the asset. But with an option, that isn't necessarily the case, depending on the type of option that you're talking about. Is that, am I confusing matters here, or does that sound about right?
That sounds right. I think it's always the if you think of the asset as the contract, then you're always buying and selling the contract, but that contract can do two things. So that's probably
rather than one.
That's probably how I'd think about trying to split it out if I was sort of trying to work out which was which. You're always buying or selling the piece of paper, but the piece of paper might say something different on it.
Yeah, very true. Yeah, it's good way of looking at it. Thanks, Hugh. So the way we're just going to kind of use a slightly abstract example for call and put options, but so rather than thinking about the sort of assets that we've been speaking about, I'm going to give an example of the film industry, and this is probably going to be a bit before the time probably of you guys. Actually, this film, probably you were probably very young when this film came out. I do remember it. But there was a film called Good Will Hunting, which was actually written. The screenplay was written by Matt Damon, who you might know for the Bourne films and what other, he's been in loads of stuff, and Ben Affleck, who played the more recent incarnation of Batman, amongst other things. And Matt and Ben Affleck went to the same university or school together. Basically, they grew up together. Two aspiring actors, and they wrote this screenplay for this film called Good Will Hunting, and it actually won an Oscar. So this was in 1994. They were looking to develop this, and what they did, they had this screenplay and this script that they'd written, and they needed to go and find a production company to turn this screenplay into a film, and this was their big break. So the film is about Matt Damon plays this cleaner at a school. At a university, and Robin Williams, who you also see in the picture there, he's quite a famous comedian, an actor. He was this maths professor that was always putting up very complex mathematical equations on his board in lectures, and no one could ever solve them. And Matt Damon was basically a maths genius disguised as a cleaner. So he would go into the classrooms and he would actually then complete these formula, and they couldn't work out who it was. And it's all about the background of Matt Damon, and Ben Affleck plays his mate, and they're ruffians. They get up to no good, but he's got this potential to be this maths whiz. So it's all kind of like the emotional. It's quite an emotional film if you ever get to watch it. But anyway, so Matt and Ben were after trying to get this script sold and turn it into a film. So here's an example of how that would have worked if it was a call option, which is pretty much what they did. Okay, so Castle Rock, which was the production company, had kind of got a little bit of wind that Matt and Ben had this script and this screenplay, and Matt and Ben had been introduced to them. So what Matt and Ben said was, I tell you what, let's put a contract in place that states that you can, Castle Rock, can buy this script from us at a particular date in the future, if you want to, but you need to put a deposit down on that. So Matt and Ben became the sellers of the option. So they wrote the contract that stated that Castle Rock, who then bought that contract and therefore the holder of that option, they had a contract that stated after 6 months at that expiry date, Castle Rock, the production company, could make a decision about whether or not they wanted to buy the script for, say, £675,000 or dollars, whatever that might be, but in exchange for a premium of 100,000, right? So Castle Rock put their deposit down, the premium down, as Elliott was talking about. And so you've got a 6-month period where Castle Rock then have to make a decision about whether or not they buy the script. So what Castle Rock are probably doing is they're probably going out, they are speaking to focus groups, audience groups, telling them about this film, seeing what they think about it. They might be talking to directors to see if they would turn this into a movie, how much it's going to cost, all that kind of stuff. Before then, they make a decision about whether or not they want to buy this film script from Matt and Ben at that expiry date in 6 months' time. Now, if they do, they then part with that money, the 675,000 agreed, and Matt and Ben give them the script. So that's quite an abstract way of looking at a call option or an example of a call option. So Matt and Ben have written the contract. The screenplay is the underlying asset. Castle Rock have bought that option. And the idea is they paid a premium to Matt and Ben, and they, after 6 months, have the option to buy that script from them for that price at that expiry date. So as Elliott said, a call option is where the buyer of the option, in this case Castle Rock, have the choice to buy. It gives them the right, but not the obligation to buy this script at the expiry date. So that is a call option. Now, if we want to kind of the more unrealistic scenario, that if we're using the same example, you can apply that and use the put option methodology and situation. So in a put option, what's likely to happen is Castle Rock write the contract and they say to Matt and Ben in that contract, you've got this film script. We want to give you the choice of whether or not you want to sell it to us at a given date, at the 6-month date. And then the unrealistic bit here is that Matt and Ben would have paid a premium to Castle Rock to be able to sell that script. Okay, so in real life, this is probably unlikely to happen because Matt and Ben have got the script, so why would they pay Castle Rock? But this is just continuing that example. So Matt and Ben now are the buyers of the option. Castle Rock are the sellers of the option. And Matt and Ben pay a premium to Castle Rock for writing the contract. And it gives Matt and Ben the option after 6 months to sell that screenplay to Castle Rock if they choose to do so. So the likelihood in this example is that Matt and Ben, in that 6-month period before it expires, may go to other production companies to see if they might buy it for a higher price. Okay, so they might go to them and say, oh, will you buy this script for 800,000, etc., and see if they can get a better deal. If production companies turn around to them and say, I'm sorry, we wouldn't turn this into a film, it's a load of nonsense, then actually when it gets to that expiry date, Matt and Ben still have the right, okay, they have the right to sell that script for the agreed amount in that contract. So this is an example of how you can reverse that call option scenario, and this would be what it would look like if it was a put option. So Matt and Ben are now the buyer of the option, Castle Rock are the sellers, and it gives Matt and Ben the right to sell that asset, the script, to Castle Rock for the amount agreed at that expiry date if they choose to do so. So it kind of flips it slightly. So that's this is the least likely scenario because the call option example is actually what happened with this film. But this, just using that example, this is how you would reverse it so that the put option makes sense. But in reality, this is unlikely that it would have happened. So that kind of gives you that example there of how a call and a put option works. So in that put option example, Matt and Ben, who are the buyers of the option, now have the right to sell the asset, whereas in the call option example, Castle Rock, that were the buyer of the option, had the right to buy the script at the agreed price. Okay, so that kind of concludes options. We've spoken about futures, and obviously we looked at forwards in the previous session. Before we finish, gents, is there anything that you'd like to add to any of that we haven't covered off that you feel would be of benefit to anyone watching?
I think that was pretty solid, Matthew. I guess one thing that's probably not going to be tested, but just again, hopefully for the viewers to sort of understand the motivations of the options and how they work and how they slightly differ from futures and forwards. You can see that having an option to do something in an uncertain world becomes valuable. If there's a big chance that, you know, prices can move up or down, then having an option does become valuable, you know, as opposed to being committed to do something. So that can just help you think about why someone may want to have an option as opposed to, you know, commit themselves and be obliged from day one.
Yeah, that's a really good point, Elliott. Absolutely. Yeah, it's a good why people use them. Yeah, absolutely. Really good point. Sorry, Hugh, was there anything you
no, I was
wanted
just going to say, just to add on to that exact point of you don't necessarily you might not in real terms actually keep it till expiry, because if the world is getting a bit crazy and therefore options are valuable in exactly the way Elliott just described, well, you might sell it. You might like, oh, the world's a bit crazy right now, options are really valuable, but I think things are going to calm down before it expires, so I'm going to sell it now and make some profit off of it. So you can use them as pure sort of pure speculation assets, with this is not necessarily insuring something in the way that sort of the Goodwill Hunting example was.
So more speculating than hedging.
Yeah.
Yeah, absolutely.
Well, you use
absolutely.
it for both, but yes.
Yeah, sure. Excellent. Well, thanks very much, gents. So that concludes everything for derivatives. We've covered everything that we need to look at now. We don't need to go into too much detail about these. It's kind of understanding the basics of it. But yeah, options tend to be the one thing that I have historically seen with students studying this struggle to get their heads around the difference between a call and put option. So obviously being aware of that and those differences there are really important. And it's really good. Thanks, guys, for kind of recapping on the whole hedging and speculating and the uses of derivatives and how options could be used to do that as well. So it just remains me to say thank you very much, gents. It's been great having you speaking to students. It's been good to see you again, Elliott, and really nice to see you, Hugh, and meet you for the first time. And thanks for sharing your career insights and what you've been doing as well. So really appreciate it. So thanks very much, gents, and we will see everyone for another session at some point soon. Thanks, guys.
Thanks, guys.
Thank you very much.